Our headliner now, Dubravko Lakos is J.P. Morgan's head of equity strategy. He says the momentum unwind is all but over. Dubravko, what makes you so sure?
Hey, Scott. Thanks for having me. Yeah, look, we've basically been starting to say early March that significant dose of this, call it de-risking within growth, has happened. In other words, growth has, decoupled from momentum, and we thought that the risk reward for the growth rate generally is no longer as negative. If anything, is improving. So that could present like a tactical opportunity to step in and buy some growth. Parts of growth are also definitely looking more GARPy, growth at a reasonable price. But having said that, for us, really the message here was that you can now actually start to see a somewhat more broader participation in the market, where in addition to the cyclical side of the trade, you can start to see a little bit more life within the growth side. So we think, look, the two big themes, reflation and the reopening, are still alive. I know, stock leadership is not suggesting that the last 2 weeks, but we think they're still alive, and we still need to basically go through a significant portion of the reopening trade, which, by the way, abroad has gotten delayed. So things have gotten pushed out a bit.
I just feel like it's hard to convince people that rates aren't going to continue to rise and that the momentum in growth trade could be hurt by that. If you believe what the Fed chair said, if you believe what Professor Siegel said last week to us, he thinks inflation is going to run hotter than people think. He still doesn't think that the Fed's going to do anything about it anytime soon. But under that environment, doesn't value and cyclical continue to outperform momentum?
It should, but here's the thing. It should, yes. But my momentum, right, which I know everybody is so zoned in on for the right reasons, because momentum is typically where the money is going. Momentum is a dynamic factor. It changes its exposure, and momentum has been increasingly shifting away from growth into value. So momentum is really more value, reopening, epicenter, cyclical now than it was at any point in the last several years, and it's much less so growth than what it was, say, 6 months ago or 9 months ago. And so that's why I think that the cyclical trade, yes, I think should remain the favored one as we continue to see upward pressure on yields, and you continue to see this, call it reflationary impulse as we reopen. And momentum is already aligned with that. So I think that's going to keep pushing momentum a little bit higher. I think the growth side, which is decoupled from momentum, we're basically saying is no longer as risky. The risk reward is better. So it doesn't have to necessarily go through the same volatility that it went through, let's say, throughout the month of February earlier this year.
But you think that you think that earnings are going to be strong enough to justify a pretty hefty multiple, right? Because you've got your earnings expectations, your estimate at 185, and as we were talking earlier, your base case is 4,400. That's 24 times. That's okay?
Yeah, look. So again, it all depends on where are you in the equity cycle. Are you in the earlier innings? Are you in the later innings? And that, I think, justifies different levels of multiple. We're in the earlier innings. The Fed is still very, very supportive, and I think that generally justifies higher multiples than otherwise, right? So now, obviously, you fast forward 6 months from now, if the Fed is talking about tapering, we're much deeper in the reopening trade, then the multiple story, I think, starts to change, and you likely will see compression. But I don't think we're there yet.